In this video, I'm going to demonstrate problem 3.5a. In 3.5a, we're going to be preparing a trial balance and a set of financial statements, an income statement, a statement of owner's equity, and a balance sheet. And the information that we need in 3.5a comes from problem 3.4a, which is a problem that I demonstrated in my previous video. So we're going to start off where that problem left off. So now I'm looking at the T accounts that resulted from problem 3.4a. And the very first thing that we have to do in order to prepare a trial balance is to find the balances of each one of these T accounts. So we need to do that. And I'm going to demonstrate how to do that with the accounts receivable account here. So the accounts receivable account has activity on both the debit side and the credit side of the T account. And we have activity on both sides of the T account. What we need to do is we need to find the totals of both sides of the T account. So on the debit side of accounts receivable, I have two postings, one of $14,000 and another one for $16,000. So I'm going to add those two amounts together to get $30,000. And I draw a line across the bottom of the T account to indicate that I totaled that side, and I write that $30,000 total on the left side. That's called a footing when we total both sides of the T accounts. I'm also going to do the same kind of thing on the right side of the account receivable T account. I have two postings there as well, one of $7,000, another of $8,000, so I'm going to add those two amounts together to get $15,000 footing on the right side of accounts receivables T account. So to find the balance of any T account, we take the difference between the two totals. So in this instance, we're going to take $30,000 and subtract $15,000, which also equals $15,000. I'm going to draw a line across the bottom of the T account to indicate that I did that math, and then I'm going to write that balance, that difference between the two sides on the side that was larger. Since the $30,000 exceeded the $15,000, I'm going to write that balance on that debit side. And I'm also going to label it with the word balance. Now we need to do basically the same thing for all the remaining T accounts and find their balances. So why don't you pause the video for a minute and do that, and then you'll come back and check your answers against mine. All right, I'm back. You can check your balances against mine. For those accounts that had more than one posting, I footed the totals and calculated the balance. If the account only had one posting, then there was no need to calculate a balance because it would equal that one posting. All right, so now that we've found the balances of all of these T accounts, our next step is to prepare what is called a trial balance. A trial balance is an internal document, a statement, to test the accuracy of the total debits and the total credits after transactions have been recorded. The course the working papers for this textbook have some blank forms that we can use on pages 20 and 21 for this particular problem. So the first thing we're going to do with a trial balance is we've got our three-line heading again that we saw when we were doing financial statements. So we're going to throw the company's name on the first line. So Vincent Sutton, Landscape Consultant. On the second line, we write the name of the document that we're preparing, the report that we're preparing. This is a trial balance. And a trial balance is usually dated as of the end of the period. And it says in 3.5a's instructions to assume that all of these transactions occurred during the month of June. So we're going to write June 30th for our date. So now what we do is we go through our list of T accounts and we write down each name of each T account and its end balance. And we write that end balance in the appropriate column depending on whether it's a debit or credit balance in our T account. So for example, for our cash T account, we can see that the balance at the end of the period for cash was $69,065, and it was on the left side. It was on the debit side. So that's the very first thing we're going to do here is we're going to put our cash on our first line and show that balance in the debit column. And from there, we just continue down the list. So the next one is accounts receivable. It also had a debit balance, but the amount was $15,000. So that's what it's going to go on our second line is accounts receivable and the amount in the debit column for $15,000. And we're going to continue that for all of the remaining accounts. And when we get done, we're going to total them out. And here is where we have the moment of truth. This total that we're going to show on line 22 in this case we're going to show two totals. We're going to show the total of all the debit balances. We're also going to show the total of all the credit balances. And what we should see is that those two totals match up exactly. And fortunately, they do. If those two totals did not match, then that indicates that we made some type of mistake. Now, there are a few different ways to look for our mistakes. The first thing that I would suggest doing if your two totals don't match is take the difference between the two totals. That might indicate that you omitted an amount in your calculations that you shouldn't have. Perhaps you did not list one of the account balances on this trial balance. Well, then you'd be off by exactly that amount. Another little trick that you can do is take the difference between the two totals and divide it by 2. What that might indicate is that you added when you were supposed to subtract, or vice versa. That could also indicate that when you carried the information over from the T accounts to this trial balance, that you carried it over a balance in the wrong column. You put a debit balance in the credit column, or vice versa. Lastly, another little trick that you can use to help you find errors is if you have a difference between the two totals, and that difference is divisible by 9 into a whole number. What that might indicate is that you made either a slide error or a transposition error. A slide error is when either you add a 0 to the number or you forgot a 0 with the number. You slid over the decimal point, essentially. Or a transposition error is when you transpose two digits. Maybe you recorded 1,250 as 2,150. These tricks, however, can only help you out if there is only one error. Now, since we got the trial balance totals to match up, we are ready to prepare our financial statements. And if you remember from chapter 2, we always prepare the financial statements in a particular order because one statement feeds the next statement. And the first statement that we always start off with is our income statement. You may remember that when we're preparing financial statements, we always use a 3-line heading. And the first line is always going to be the company's name, in this case, Vincent Sutton Landscape Consultant. The second line is the name of the financial statement, in this case, income statement. And an income statement always covers a period of time. It shows, in this case, the activity that occurred during the month of June, which is why we wrote month ended June 30th. This is activity from June 1 through June 30th. Now, you might recall from my chapter 2 videos that in order to remember what goes on each financial statement, it helps to think of a formula. On the income statement, we're always going to be taking our revenues and subtracting our expenses to arrive at either our net income, and that's what we would call the difference if the revenues exceeded the expenses, or if the expenses exceeded the revenues, then the business lost money, and we would refer to the difference as the net loss. So by thinking of that formula, that will help you remember how the financial statement is set up. So that's the very first thing that we're going to do here is we are going to put a label for our different revenue accounts. Now, revenue accounts, when we're looking for them in a list, usually have the word revenue, the word earned, or the word income in their name. And if we scan this list, we only see one account name that fits that bill, fees income. So that looks like the only source of revenue for that business. And the balance of the revenue was $52,700. So that's what we're going to show on this financial statement. Now, once again, on financial statements, the columns do not represent debits and credits like they do in the T accounts as well as they did on the trial balance. The two columns here are really just formatting, used for formatting to make it look nice and presentable. And what we usually do is put totals in the right column and numbers that we add or subtract to get totals in the left column. And since that was the only revenue account, we're going to throw that revenue in the right column because it is the total revenue for this business. All right, the next part of an income statement is to list out all of our expenses. And before we do that, we're going to put a heading for our expenses. And then we go through the list. Now, in the trial balance, the accounts are organized by account type. So we have all the expenses at the bottom of the list of accounts on our trial balance, starting with rent expense. So essentially, we're going to carry that information over for all 5 of these expenses in this case. And since we have 5 of those expenses, we are going to list each of those amounts in the left column, and then we are going to total those expenses and place the total over on the right. I also will draw a line at the bottom of the last expense there to show that those expenses were totaled. And then I'm going to put a label for the total expenses and actually do the calculation by adding those 5 expenses up. I place that total expenses on the right column because it is a total. And now I'm going to calculate the net income or the net loss for the business during the month of June. Now in this example, the business earned revenues of $52,700 and they had expenses of $21,455. The revenues exceeded the expenses, so the business made a profit. When the revenues exceed the expenses, we call the difference a net income and list it as a positive number. When the expenses exceed the revenues, we refer to that as a net loss and we show that as a negative number. So in this case, we're going to do the subtraction, 52,700 less 21,455, which gives us 31,245, and we're going to label that as our net income. Now we got to remember that we do those financial statements in a particular order. One statement feeds the next. So when we do the statement of owner's equity, we're going to need to bring this $31,245 net income forward when we do that. So we will do that in just a moment. Once again, when we prepare financial statements, we always have the 3-line heading, with the first line being the company's name, in this case, Vincent Sutton Landscape Consultant. The second line being the name of the financial statement. The statement of owner's equity is what we're going to prepare now. And the statement of owner's equity covers a period of time just like the income statement does. So the way that we write the period of time is month ended June 30th. Once again, I suggest remembering a formula to think about each financial statement. And the formula that goes along with our statement of owner's equity shows that we're always going to start off with the beginning owner's equity. We would then add or subtract our net income or our net loss. Net income would be added, whereas loss would be subtracted. Then we would subtract any amounts that the owners withdrew during the period, which would equal the owner's equity at the end of the period. So once again, remembering these formulas can give you a skeletal outline of what goes on that particular financial statement. So for this problem, Vincent had made an investment into the business at the beginning of June in the amount of $90,000. So that's the first thing that I list out. Next, I need to recall the net income or net loss that the business made during the month of June. And that's what we did on our income statement. So I'm going to click back on the worksheet that contained our income statement so that I can recall the amount of net income of $31,245. And it was a net income as opposed to a loss, so that is going to be added. Next, I'm going to list out any amounts that the owners withdrew during the period. And if I go back to my trial balance, I can see that the owner's drawing account had a balance of $5,500. So that's what we're going to do next, is subtract out the withdrawals of $5,500. In this example, since the net income of $31,245 exceeded the amounts withdrawn of $5,500, the owner's capital is going to increase during this period. So that's what the next line is, either going to be an increase in capital or a decrease in capital. And since the net income exceeded the withdrawals, we're going to have an increase in capital. So I'm going to take the difference between those two amounts and show that. So we can see that the owner's capital increased by $25,745 during the month of June. So last thing to do here is to figure out the capital as of the end of June. So to do that, we're going to take the capital at the beginning of June and add the increase in capital that occurred during June. So the appropriate label is Vincent Sutton Capital as of June 30th. And if I take that $90,000 and add that $25,745, that gives us $115,745 as our ending capital. Once again, each of these financial statements feeds the next statement. So in order to do the balance sheet, we need to carry this ending capital figure forward. So we're going to need to recall this amount in a few moments when we get to that portion of our balance sheet. Once again, financial statements always have a 3-row heading. The first row is going to be the name of the company, Vincent Sutton Landscape Consultant. The second line is going to be the name of the financial statement, in this case balance sheet. And on the third line, for a balance sheet, we're going to write the date that that particular balance sheet was prepared. We want to think of a balance sheet as representing a particular moment in time. What was the balance of cash at a particular instant in time? It's different than the way that we labeled the date for the statement of owner's equity and the income statement, because those covered a period of time, whereas the balance sheet is showing the balances as of a particular instant in time. So when we prepare a balance sheet, we want to think of our accounting equation. That accounting equation is going to give us our skeletal outline of our balance sheet. And if you remember our accounting equation says that assets equal liabilities plus owner's equity. So that's what we're going to do here is on the left side of the balance sheet, we're going to list out all of our assets. And on the right side, we're going to list out our liabilities and owner equity accounts. And we're going to show a heading for our assets to begin with. And once we've put our heading out there for our assets, then we need to list each of the assets individually. So we're going to go back to our trial balance and we're going to look at our list of assets. In this example, there are 4 assets listed: cash, accounts receivable, office furniture, and office supplies. So I'm going to copy those over to our balance sheet and list those balances out. Once we've listed all of our assets, we need to total those assets and show that amount on the balance sheet. So if we add those 4 assets together, the total assets is $140,445. So now on the right side, we're going to go into our liabilities and our owner's equity. And the first thing I'm going to do is show a heading for my liabilities. And then I'm going to go back to my trial balance to look at my liability accounts. So in this case, there was only one liability account. For liability accounts, we're typically looking for the word payable or the word unearned, and we only see accounts payable in this list. So we're going to carry over that $24,700 balance for account. Since there is only one liability, I don't need to separately show a total liabilities because it would be the same amount. So now I can move on to my equity account. So I'm going to put a heading for owner's equity. And once again, these financial statements are prepared in a particular order. One statement feeds the next. From the statement of owner's equity, we're going to grab Vincent Sutton's capital as of the end of June and bring that forward to this balance sheet. Since the balance sheet is showing that the accounting equation is in balance, our last step here is to show that the total of the liabilities and the owner's equity matches up with our assets. So I'm going to add the account payable and the capital balances here to figure out the total of the liabilities and equity, and I'm also going to label that. As we can see, the total of our liabilities and owner's equity does in fact match our assets, so we are good. We have done this correctly. All right, we just did problem 3.5a. It would be a good idea if you tried 3.5b on your own.